Right, we're getting slightly closer to realistic financial things and the bank crash 2007. If we look at these set of things, these are financial market bubbles. Now, one of the interesting things over the years that has changed is that the early economic bubbles, they involved trading in shares. It wasn't an organized trade, for example, as you would get now through stock exchange and so on. I mean, there were trades between merchants and so on. Now, in these things, these are really sort of markets, sort of exchange chairs here. These are some like trading on the London Stock Exchange and Wall Street in Japan and so on. And again, all of these things, as you see at the end here, it says the bank crisis 2007. All of these things depended on irrational exuberance. The notion that the price of the shares was keep going to go up, and it's almost a notion that the shares became completely divorced from the underlying real markets. For example, if you look at the dot-com bubble, that was a bubble basically in the United States, which had to do with the first great internet explosion, companies running services on the web, on the internet, and so on. Very few. I mean, there was a lot of very, very valuable sort of internet online companies in 1995 that didn't survive 2001. Companies like Amazon are perhaps one of the few that did. And again, it was irrational exuberance. It was people started bidding up the price of these companies, and then as the prices kept going up, the notion was you could sell them and make a profit. Therefore, some you could buy them and again make a profit, even if everybody believed at some distant time in the future the market would fall over and the price would fall back down. And I'm afraid that is the outstanding characteristic of all market bubbles, is that the prices bid up in an irrational way, and at some stage the bubble bursts and price crashes back down again. Now, there's common characteristics of all these things, going from the early market bubbles that relied on physical assets to the later market bubbles that seemed to rely on just computer numbers on computer screens. Now, the common characteristics is this, that the trade always relates to the prospects of future profits. So at the base of all these things is the notion that there's an asset that's valuable and that the price that asset is going to keep going up. Now, at some stage, I mean, as I've said already, the market loses sight almost of that asset, and it just concentrates on the fact that the price is going up. Now, the second common characteristic is good information is the key to reasonable predictions. And by that I mean that people who know a great deal about the underlying asset can make good predictions about what's going to happen. People who don't know, and in general in these sort of markets, and it's very important in the second video where I start talking about what actually happened in the banking crisis, in that the people investing in what will be I'll explain the banking crisis, complicated financial instruments, had very little understanding of the asset that these things were supposed to be based on. So they had really bad information. So the choices they made were irrational, again in the sense that all they could see was the value of these financial instruments seemed to keep going up, so they kept buying them. And that's again is the irrational exuberance. That's the very common characteristic of these things. Now, to bring us up almost up to date and to prepare us for the second video, the thing I need to explain is here is what happened in the financial markets, in the banking sector, because from about 1940, I suppose, to the early 1990s, the banking sector was very stable. There was no, as far as we could see, irrational exuberance. There was certainly no economic bubbles. Something happened. And one of the things that happened is a change in the way trading and investment happened. First of all in the United States, and secondly in the UK, and then carried on to Japan and other sectors in Europe and so on. The Big Bang, what is described as the Big Bang, which is liberalization of trading on the stock exchange and the disappearance of the a very important distinction between retail banks. Retail banks, by the way, are the sort of banks you see in the high street where you go and you put money in, you've got checking accounts, and you know you use your plastic, and I don't know, if you as a normal person want a loan, you might go in and ask for a loan and so on. And investment banks are the people who dealt traditionally in stocks and shares and large sums of money and so on. Now, the Big Bang happened in London basically because London was starting to lose in the competition with Wall Street. Wall Street in the States had become liberalised before London did. Now, one of the reasons I mentioned a few moments ago that the banking system seemed terribly stable from about 1940, sometime the 1990s. One of the reasons that was because after the Great Depression of the 1920s and 30s, the United States Congress passed a law which separated retail and investment banking. This is what's known as the Glass-Steagall Act in 1933, if I remember correctly. And that act really said retail banks cannot act as investment banks. Now that act was finally repealed in the 1980s. Big banks had been sort of getting around some of its provisions before then, but it was finally repealed in the 1980s. That meant that the way Wall Street worked, the way the financial sector in the United States worked, became very different to traditionally the way that the City of London worked. And that's the thing that gave rise to the Big Bang in London in 1989. Now, the essential thing here at Big Bang was that retail banks, the distinction between retail banks and investment banks disappeared. Trading in stocks and shares greatly changed. The division between those who could buy and sell shares and how banks could actually invest and trade changed greatly. One of the very important things that happened here is that banks could now invest and trade in stocks, futures, and other financial instruments on their own behalf. Up to Big Bang, and in the United States up to the repeal of the Glass-Steagall Act, retail banks couldn't do this. Investment banks had some ability to do this. What happened after Big Bang is that the small investment banks basically either completely disappeared, were absorbed by one of the large, what we now understand as the large banks like Barclays, HSBC, Royal Bank of Scotland, and so on. And in order to compete with Wall Street, that is the financial sector in the United States, London effectively became a very open, deregulated financial marketplace space. So essentially, one of the things that has stopped rational exuberance in the banking system, one of the things that has stopped the big retail banks investing and trading on the stock exchange, buying futures, buying stocks and shares and so on, that disappeared in 1989 in London. It had previously disappeared in Wall Street. It disappeared very quickly after Big Bang in. Now, one of the important things to understand about why things like banking crisis happen is notions of risk and uncertainty. And in economic theory, there's a concept of risk and uncertainty which was developed, I think, by Frank Knight possibly 40 to 50 years ago, where he distinguished between risk, which is a situation where the possible outcomes are known. What you don't know is exactly which one of these outcomes is going to occur. And uncertainty, a situation where there is a number of possible outcomes, some of which are unknown and perhaps unknowable, and where you can't attach probability to. So the situation of risk is something simple like tossing a coin. If you toss a coin, there's two possibilities. Either it comes up heads or it comes up tails. The probability, therefore, of tossing a coin coming up heads is 50%, or it has a probability of 0.5. Now that's significantly different to, say, the situation to my trying to work out what exactly I'm going to be doing on the 6th of October next year, or in fact 6th of October this year indeed. There's lots of possibilities here, some of which I just can't predict, are unknown to me. Now, what happens when people try and work out that sort of problem is that you tend to say, well, it's reasonable to assume that lots of things will stay the same. So, for example, the 6th of October this year is a Thursday. I could assume that I'm still teaching this module. So at 10 o'clock on the 6th of October, the likelihood is I'll either be sitting in the canteen having a cup of tea because I'm not doing the lecture that day, or taking a lecture at this particular time. Now, however, that's so, I could sort of rationalize what might happen on the 6th of October by saying there's roughly, on that basis, there's a 50% chance I'm taking a lecture, 50% chance I'm not. So the probability of taking a lecture is 0.5, which is roughly the same as, I suppose, the coin tossing problem. However, the difference here is that I'm meeting risk in a rather different way here. I'm basically saying my expectations are that the risk is going to be like that. I cannot prove that they're the only two possibilities. In fact, given the 6th of October some time away, I could have died, been run over by a bus, the building could have fallen down, whatever, I don't know. We may have no students. I mean, all these things are extremely unlikely, of course, but the possibilities. And there's also other things could happen which I can't even sort of put into words because I have no idea what they are. So those possibilities exist. And to a large extent, this is the problem when people work out sophisticated mathematical models of what's going to happen in the future. The banking crisis, the way banks decided to change their lending practices, has that problem. When I say that it's very likely on the 6th of October I'll be teaching or having a cup of tea in the canteen, I'm assuming all other things stay the same. The way banks worked out from Big Bang in 1989 to when things went really wrong in 2007, the models they were using worked on pretty much the same basis. Of course, perhaps a lot more sophisticated than what I'm saying, but pretty much the same basis. They were assuming that the immediate past was a good guide to the immediate future. In the banking crisis, it turned out not to be. Other things happened which they didn't sort of expect. But that's what we're saying here. There's expectations built into this sort of thing. Sorry, I've gone too far here. Okay, so just reiterate here. If we went back to the historical video, I had a list of market bubbles, including some financial market bubbles. Now, three very significant ones happened after Big Bang, happened after deregulation. That was the dot-com bubble in 1995, the Asian financial crisis, which was something like the financial crisis we've had in worldwide markets in 2007, but it was confined basically to Southeast Asia, I suppose, and the banking crisis of 2007. Now, these are significantly different things. In the earlier economic bubbles that I spoke about in the historical video, the early ones were to do with speculation of what might happen to physical products. The financial market bubble just had to do with increases in the money value of things. There's no reproduction, for example, involved in the banking crisis. It's just sums of money turning over and so on. And that again is perhaps a significant change